Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 23, we're going to talk about a strategy known as the reverse gift, which can be, if deployed correctly, a huge income tax saving opportunity. Now, as always, this presentation is not legal or tax advice, so if you want to implement this strategy, you should consult with your own attorney or tax advisor. But the premise around which this strategy is built is colloquially known as the step-up in basis at death. So, under Code Section 1014, under the tax code, any assets that are owned or treated as owned by a decedent upon their death will have their basis adjusted to the fair market value of that asset at the decedent's death. Now, we typically assume that assets are going to appreciate in value over time, which is why this is commonly known as a step-up in basis. And the effect is that the heirs can turn around and sell this property and not have to pay any income tax on the gain that accrued during the decedent's life, because that gain is wiped out and won't be subject to income tax by virtue of this step up in basis. But there is a double-edged sword here. If assets go down in value during the decedent's life, there is a step down in basis, meaning that heirs cannot harvest any tax loss that accrues during the decedent's life either. Now, this basis adjustment is designed to reconcile the fact that estate tax is paid on the fair market value of assets, and that estate tax is designed to replace any income tax gain or loss that would otherwise be incurred by the heirs of the estate. Now, this isn't a perfect solution, and it creates a huge loophole in the tax code, because estate tax need not be paid in order to get this step up in basis, which is a big difference from the gift tax, where you can get a step up in basis for gifted assets, but only to the extent gift tax is actually paid out of pocket. With the estate tax here, and a step up in basis in assets at death, you can use the estate tax exclusion of the owner of those assets to step up to 11.58 million worth of assets without ever paying a dime of estate tax. So that's a huge planning opportunity, especially right now with the estate tax exclusion being as high as it is. Now, one caveat I want to note here is that the step up in basis does not apply to all assets that might otherwise be subject to estate tax. Some common categories that are not included in the step up would be things like retirement plan assets, IRAs, annuities, and promissory notes that are payable to the decedent, because these items are known as income in respect of a decedent, and the IRS wants to make sure that these sources of income, which are essentially tax deferred, will still incur income tax when received by heirs or beneficiaries. But either way, the big question here in the planning opportunity is, could you harvest somebody else's exclusion amount within your family, be it a parent or spouse or somebody else? And the answer is yes. So just for simplicity's sake, we're going to assume that you have a parent who will not use their full 11.58 million exclusion. So the question is, could you gift assets to them and get the step up in basis at their death, with the assumption that they'll return the assets to you through their estate plan? Because the goal here would be that you could harvest that step up in basis using their exclusion and then turn around and sell the asset without having to pay any income tax on that gain. And the answer to that question is generally yes, you can, but there is a limitation. More than 1 year must pass between the time you gift the assets to your parent and the time those assets come back to you as a result of their death. So really, the 1 year period is between the date of the gift and the date of the parent's death. So if it's 1 year or less that passes, the basis of the property when it comes back to you or when it's sold by the parent's estate will be the same as it was at the time of the gift. And the rule with respect to a sale by the parent's estate applies if the proceeds are returned to you. Now, it's important to note that this 1 year period doesn't have to be met if the assets will go to somebody else. So if you wanted a planning opportunity, for example, to send the asset to maybe your children and allow them to sell the asset with a step up in basis, then you could do this without having to worry about this 1 year limitation. Now, this transaction and this structure is often known as the reverse gift. Now, beyond the 1-year limitation by itself, there are some practical pitfalls and facts and circumstances to be aware of. One, obviously, you need to be aware of the health status of the donee parent, because if they have poor health, that increases the risk that they could die within 1 year of the initial gift. So, if early death is anticipated, it might be worth it to instead make your wishes known that the asset might go on to your children instead of back to you. But that being said, it's important to note that the parent also controls the asset. They have no obligation to give the asset back to you, or even to hold on to it and not sell it. So you need to be aware of the donee parent's financial status and the fact that they could sell the asset on their own and use the proceeds, and it might be lost forever. You don't control the asset once you've gifted it to the parent. And also, if the estate tax exclusion goes down by operation of law or by legislative action before the parent's death, the ticket to entry of getting this step up in basis might be a 40% estate tax on some or all of that asset. So that risk there may not make this a worthwhile strategy and may cost more in the long run if there is a change in law. And then if you die first, you're never going to reap that benefit either. And that's especially important when you look at the fact that you, as the donor, must use some of your own gift tax exclusion when the gift is made to the parent. Now, some of that is reconciled at the end of the day because the asset that comes back to you will result in a shift of that asset from your adjusted taxable gifts bucket to your taxable estate, which restores practically some of your exclusion amount, as we looked at, especially with the estate tax anti-clawback regulation and credit that's associated with that. But one way to avoid that risk is by making the gift to your spouse. If your spouse has a situation where they could potentially die soon and you could harvest that step up in basis, because you could use the unlimited marital deduction to avoid usage of your gift tax exclusion in that case. Now, the question here is, to avoid some of these control issues and maybe the 1-year risk, could you make a reverse gift by using a trust? And when trusts get involved, we're not going to dive into this fully, but this is often known as upstream planning, where you make a parent a beneficiary of a trust or give them some level of control of a trust through a general power of appointment, so that they are treated as the owner of the trust assets at their death, and you can get this step up in basis. Now, it's important to note that in order to get the step up, this must be a completed gift, so the trust should be irrevocable. And then, if the donee parent dies within a year, it may be a good idea to have terms in the trust that dictate that the donor or settlor of the property cannot benefit from the gifted property, so that you can still get that step up in basis on behalf of your children or the other trust beneficiaries. So that's it on our discussion of reverse gifts. By no means is this all-inclusive, but it does cover some of the high points if you want to consider this type of strategy. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.